Good evening, folks. Joining with me today, I have two amazing individuals, Rajan and Abhishek. Rajan leads Sequoia's Surge, an early stage startup accelerator. Abhishek is an investor at Nexus Venture Partners, where he leads their enterprise and healthcare investments. Good evening, Abhishek and Rajan. Glad to have you here today.
Indus, thanks for having us.
Thank you, Indus, for having us.
So Rajan, first question to you. So Sequoia wrote this famous Black Swan document before we got into this coronavirus situation. How did you realize, or how and when did you first realize that this is the Black Swan moment? Were there specific indicators that you thought that we will live into this for a long period of time? Did you see this coming?
Yeah, we had an internal call where we had a global healthcare expert actually speak to the partnership on, I think this must have been sometime in February. I don't recall exactly when in February, but it was pretty early. Maybe it was 3 or 4 weeks after the world knew what was going on in Wuhan. And this expert was, this is one of the most well-known sort of healthcare firms. And they laid out sort of what they've been seeing in China and also how they thought this would move around the world. And that was an eye-opening call. So that day, I think after that call, those of us on the call sort of realized this is not something that's going to pass. Number one, it's not going to be restricted to China. Number two, it's going to go around the world. Number three, it's going to really, really accelerate. And it's also not something that's going to be 1 or 2 quarter phenomenon. So that's when, and then every single passing day, the data seemed to validate that is what's likely going to happen. So I'd say from sort of, I can't remember if it was mid-February or late February, but around then, I'd say it was probably 2 weeks before the Sequoia, our US team, published the blog on Black Swan 2020.
Great. Abhishek, what are your thoughts? When did you see it first coming?
Yeah, I think I'm trying to place the time, but probably towards the end of February, maybe early March. I think it started becoming obvious that this is no longer a one nation phenomena. Every country is sort of, learning to, trying to figure out, how to deal with it. And in many ways, at that point started becoming clear that the situation looks pretty unprecedented because for the first time, we have a health and economic crisis coming together where, both health and economy, appear to be sort of at odds with each other. Usually we are, usually all of us, use past to predict future and rely on learnings from the past, but it seems like all the prior examples, whether it's Great Depression or, 2008, 2009, the previous situations were either health or economic. And for the first time, we were seeing sort of a complex situation like this. And, at that point, I think it started becoming a bit more obvious that, until we have a vaccine, probably physical distancing and lockdowns are going to be the solution. And that might affect the services economy pretty drastically because that's largely dependent on people-to-people interactions. And what happens, I think the worst imagination, one of the first worst imaginations was that, what happens when, any company where that's directly or indirectly dependent on movement of people or people-to-people contact, their business goes to zero because at least I don't know any company that ever models for zero revenue. All the financial models, you can argue whether the growth is up or down, but you never model for zero. So I guess probably early March is, when it became obvious to us.
Got it. And we are almost 3.5 months into this pandemic situation, and a lot of changes I have personally noticed. And both Rajan, you and Abhishek are technology and software investors. What impact are you seeing in the software investment climate? I will go with Abhishek first.
Yeah, I think one is the overall investment climate, and second is specifically software. I think overall, I feel early stage there has been a slowdown because in early stages, largely investors are looking to build comfort around the team and people, and that modus operandi has been based on in-person meetings. So I think at the seed stage, although I will say given the check sizes are smaller, I think by and large investors have still been quite active, and it's not as affected, but I think Series A and Series Bs are quite affected because the check sizes can be 5, 10, $20 million, and several investors have not been, I would say, used to making such big commitments in early stages, without knowing the founders in person. But I think growth stage is largely unaffected because obviously there are metrics, numbers to assess. So I think growth stage, on the contrary, has been, I think, quite active. Overall, I feel there is a strong desire desire from investors to look at technology companies because in this environment, technology is the answer to do more with less, and there is growing demand for technology and automation. And what's happening though is that this is a live test for SaaS companies, that which products are essential and which are not so essential. And I think companies that are serving real problems, I think, are still facing a lot of tailwinds, and there is a strong desire from investors to sort of continue investing behind them. And as you would be seeing, public markets remain quite strong and bullish. In fact, and tech stocks continue to outperform S&P by a wide margin. Overall SaaS companies, I think, are benefiting dramatically from the remote work and distributed work tailwinds.
Got it. It's kind of surprising, to your last comment that on one side unemployment is up, but the stock market doesn't just stop itself going up, right? So going back to you, Rajan, do you see the same slowness in the last 90 days, or have you noticed that investments in different stages of startups life cycle, A versus seed versus B, there is a downtick that's happening?
Yeah, overall, I'd say, speaking for India and Southeast Asia, there has been an overall slowdown in investment activity, right? And it's been driven by several factors. Firstly, as you know, most venture capital firms are spending disproportionate amount of time, or have been, for the first couple of months with their existing portfolio companies, really helping them, make sure that they make the right decisions that'll help them sort of survive the storm, if you will. I think second, the lack of the tremendous uncertainty makes it very difficult, especially for larger companies or later stage companies. Just uncertainty around how long is this going to last. What's going to happen to demand curves and things like that. So I think the level of uncertainty is very high, and obviously that impacts later stage investments, I think, more so than earlier stage investments. And the third one is, look, there's been a practical reality of not being able to travel, not being able to meet companies face to face. Although that third one, I'm amazed to see how quickly we've overcome, I think, as an ecosystem, the ability to make investment decisions without actually meeting founders, right? So I think all three of those have led to, and maybe the fourth factor is, look, at least in the very, very early stages, right? We are not seeing as many net new startups, right? Entrepreneurs leaving, let's say, a Flipkart, or I'm talking about India, leaving a Flipkart or a Freshworks or a Google or an Amazon to start up companies. I think that has just simply slowed because of this unprecedented environment that we're in. But I'd say that's probably less of a factor. But it's really the first three factors that I mentioned. So overall, we have seen a slowdown. But then when you double click to that, I think it's also then the next thing is sort of which firms continue to be investing. So for instance, At Sequoia, we are very much open for business. We continue to be very active from seed through A, through growth. I think our growth teams, are probably busier than they've ever been. So there will be some firms that I think will continue to be active, but generally, at the overall ecosystem level, there certainly has been a slowdown, and I think it's going to take some time for it to come back, right? Primarily because of the uncertainty. Now, moving to SaaS, I would say SaaS it will likely buck the trend. If you look at today across sort of tech sectors, where is the most excitement? I would say number one would be edtech, because clearly it's been extraordinary sort of tailwinds in edtech. But close behind would be SaaS, right? And I think SaaS benefits from the fact that it's purely digital. I think we all, I mean, personally speaking for myself, I expected to see a bigger impact on many SaaS companies, in terms of churn, in terms of what would happen to your days sales outstanding, in terms of how many customers would cancel contracts. That's happened in some cases, and Abhishek's point, if the product is a nice to have, then I think clearly that's going to be quite tough. But for a lot of companies, we have seen an impact. I mean, churn has gone up, but not as much as we had thought it would. DSO, days sales outstanding, has increased, but again, not as much as we would have thought. And in fact, net new closures continue to happen, right, in many SaaS segments. So that's been pleasantly surprising. And I think this notion of I think investors are going to look for purely digital businesses, right, and purely digital businesses that can weather the storm. We sort of know what's going to happen around the world for the next 12, 18, 24 months. Economies around the world are going to be very, very challenged. But I'd say SaaS, and look, I mean, the latest Postman funding, which makes Postman the fifth Indian SaaS unicorn, right, is quite exciting. I mean, people don't realize that 2 years ago we had 0 Indian SaaS unicorns, and now we have 5, right, starting with Freshworks and then Truva and Icertis and so on. So I think, in fact, my view is that, especially from an India, Southeast Asia ecosystem standpoint, this decade, 2020 to 2030, will be the decade of Indian SaaS, and we can talk more about that. It's a combination of both India, US, India to the world plays, but also regional plays, right? We're seeing tremendous potential now just in India. I mean, if you had asked me a few years ago, can you get to 10 million ARR as a SaaS company selling only in India, I would have said, look, that's just not going to happen, right? And now we have several companies that have north of $10 million in India. And if you add India, SEA, and GCC, they're getting close to $50 million of ARR. And these are economies that, we're still in the early stages of these economies. So long answer to your question, but I do think SaaS, I think SaaS is going to, let's put it this way, if you're a SaaS founder, the likelihood that you can raise is higher than, let's say, if you're in some other, many other sectors, at least in our region, India and Southeast Asia today.
Got it. Thank you for that, Rajan. So latching on to your earlier point, you mentioned that across stages, some growth stages, fantastic, and you gave the Postman example. But if I'm a SaaS founder, mid-stage, have 12 to 18 months runway in the bank, am I safe or I should be worried, knowing that the market for mid-sized companies are still not sure and how long this is going to last? Rajan?
Yeah, I would say, we encourage our founders to have 24 months of runway. Now, this was, keep in mind, this was in March, so already we have 3 months down, right? So, but I think if you can get to about 24 months of runway, either by, kind of reducing your burn or maybe just raising a top-up round, or what have you, right? I think 24 months is probably what maybe you should aim for. I think 12 months maybe may not leave you in a place to be overly comfortable, right? So that's the first thing. I think second, look, find a way to look. I think this is a great time to reimagine every aspect of your business, right? Selling to enterprises, I think, without meeting face to face. Again, if you'd asked me 4 months ago, can you build an enterprise software company without being able to call on customers face to face, I would have said, look, it's going to be very, very difficult, right? But maybe that paradigm will change, right? And at least at the very, very early stages, I'm quite pleasantly surprised to see, obviously these are not, $3, $4, $5 million deals, but even 100, 200, 300K deals are happening with net new customers, right? So I think whether it's sales, whether it's product management, whether it's how you think about marketing, whether it's how you think about customer success, I think really reimagining how each of these functions work, I think is very, very important. And the third thing is, look, if you look at the next 12 to 18 months, thinking through which segments do you want to really go after, right? Because in some cases you may want to change your segment. So let's just take an example, right? You're an early stage company or a mid stage company, and you were selling to you were selling to hospitality and international travel. That might be a little difficult. Although I must say, Banu, who leads RateGain, right, which is India's largest sort of travel focused SaaS company. Obviously, their business is challenged, but amazingly, again, right, I would have expected, Banu was himself saying, he would have expected a bigger impact on his business. Now, the products that they sell largely are mission critical for those enterprises. So that's going to come back. So I would say, look, try to get to 24 months. And then if you can show, look, in many ways, right, it used to be SaaS companies had to grow in the US, especially, 100, 200%. You have to go from 10 million to 20 million to 40 million. I mean, that makes you a super hot sort of SaaS company, right? I think in this environment, maybe if you can go from 10 million to 13 or 14 million, right? So you almost cut the growth rate in half, but if you can still show some growth, I think you get to be very interesting, right? I think, and the last thing I'd say is, look, I mean, the world is awash with capital, right? There's $20 trillion now that is at negative interest rates. That's a lot of capital looking for returns. But so look, it's again not going to be easy, but it's very specific to the segment that you're serving, your underlying unit economics. But I would say one thing is, I think the era of burning a lot for the sake of growth, that may not be the greatest strategy, right? If you've got 18 months of runway, but you're still burning a lot, despite having strong gross margins, if you're burning a lot and maybe growing 20 or 30%, that is not a good place to be.
Got it. So if I could carry one takeaway, so wait it out. Have cash, conserve it. Of course, drive sales as much as possible.
And also reimagine Indus, right? I think reimagining is very important, because any function, the way you were doing it, let's say end of March in India, if you're a cross-border India SaaS company or a regional focused SaaS company, I think the way you were doing things at the end of March should really be, you should fundamentally reevaluate that, right? You should look at your product roadmaps and say, how do you reprioritize your product roadmap given what we know? So I would say survival is first thing, right? If you can't, just make sure you can survive. But, that's sort of, in many ways, right? If you have 24 months of runway, you have 24 months of runway. Now, question is what next? And I think a lot of companies have got to that stage, right? They've figured out a way to, if not 24, get to 18, 24 months, but then becomes what next? And we think this sort of reimagining and zero basing every aspect of your company, it's a good time to do that. It's a critical time to do that.
Great. I'm going to come to Abhishek. So Abhishek, you are in the middle of many seed and mid-stage Series A, Series B SaaS investments. You've done Apollo, you've done Ask Nicely. So in your portfolio base and in Valley in general, are companies prepared? Are they really worried about, or they are prepared that, hey, as per Rajan's point, we are ready with, few of those things. We have money in the bank, we are redoing many things, or they are not thinking this through in general beyond the 24 months. So, the question is everybody prepared with this two things in the bag in your point of view, or there is more to be worried about beyond this?
Yeah, absolutely. I think great question. I think what Rajan also mentioned, I think every startup in our portfolio, pretty much all of them, the ones you mentioned and several others, I think have prepared for more than 18, 24 months runway. Many of them have also sort of, spotted opportunities for course correction because, now the workflows that, on your customer end that you are serving, several of those workflows are also changing. So I think it's a good opportunity also to evaluate, how can the product be more product-led? And that how can the business, have lesser dependence on salespeople and can become sort of more product first. And several of our companies are also using this as an opportunity to sort of relook at the product and, ask really hard questions on the value that we create for our customers. And not just focus on seats and users and usage, but rather, what value do we actually deliver? what we are also seeing is, some of the bigger companies or later stage companies, they, they were already fortunately quite adequately funded, and they keep getting more sort of funding. I think more and more, the world is becoming between haves and have-nots. The later stage companies that have already a lot of money, they continue to attract more money. And on the earlier stage side, I think our guidance to our companies was that, let's hunker down wherever necessary. But that doesn't mean that, we cry gloom and doom, and let's continue to look at opportunities that these times present to us, and sort of use our cash wisely, not to spend, but to invest in areas that can, pay dividends. And to Rajan's point, obviously, thrival is important, but survival is first. So, but once we have ensured that, the company's financial existence is secure, I think the discussions now we are having are, let's identify opportunities, whether it's around realigning customer segments, whether it's about how do we look at our go-to-market and distribution, and where we can make it more product-led. And lastly, use these times also to maybe, address customer segments that, on the contrary, have tailwind in this environment. So for example, if let's say if a company is in the business of customer experience, and if we were going after, let's say, businesses that have brick and mortar or brick and mortar or franchisee presence, how do we also sort of add customer segments where the delivery happens rather online? So the same product, but can we sell it to a different segment, that, let's say, caters to distributed businesses, or customer support, segments that can use your product to deliver the same value, and the ones who need you in these times even more. So that makes sense.
Got it. So keeping with you, Abhishek, Rajan mentioned, one of the items is reimagining, how you do things and how you run your business beyond the survival. You mentioned product led. I'm assuming, as a founder, when you make these changes, the way you sell, the way you use technology in general, is going to give rise to newer set of tools, newer set of marketing and GTM tools, as I would say. So are we going to see more SaaS coming out, newer software and technologies coming out because of the situation we are in?
Yeah, absolutely, Indus. I think the situation has created a big opening in the market for asynchronous products, and asynchronous not just by time but also by location. So how can the same service be delivered, but in a location independent way or in a time independent ways? For example, a school where earlier teachers and students had to meet in a physical premise called classroom for the learning to happen. How can the same learning happen remotely, like the classic Zoom school phenomena now that we are looking at, or let's say fitness instructor meeting the trainee in a gym, which is a physical premise. How does Peloton sort of take care of it? So I think by and large asynchronous is a big wave, and I think several applications obviously are benefiting from it directly. I mean, Zoom being the most popular one, and Slack, DocuSign. I think several applications that are aiding productivity of a distributed employee, and making sure that that distributed employee is as productive and as engaged as he or she was when they were going to a physical premise with, let's say, 500 other people every day. And how can and that also creates sort of several meta level opportunities, both in application and infrastructure layers. In application layers, for example, we are seeing that now the call center employees are distributed, and now as the coach of those frontline agents, or somebody who's looking at quality assurance, how do you make sure that those call center agents are still taking the calls productively, and the quality standards are being met? And I think this environment, the whole distributed and asynchronous phenomena is presenting also opportunities for several new tools. The other thing is, I think now these times have thankfully changed one thing, that, whether you're old or new fashioned company, large or small, work from home is no more a luxury or or a matter of choice. I think everybody has by and large affected that it's given, and the question is, what tools do we use to make it more productive? And last thing I would add, Indus, to your question is, there are several opportunities, also meta opportunities in infrastructure. So, for example, huge uptake of cyber security products, heavy cloud usage, as we read in the in all these earnings announcements, that how public cloud companies, the usage is going out of the roof, and heavy usage of video APIs, for example, Agora, or voice APIs, Twilio, all the rails that are sort of on which this rail network of remote work is running. I think there's massive undercurrent, and I think these are just some of the names that we have heard are popular. I think there are several new tools that will come up in the coming days, I feel.
Great, fantastic. So Rajan, similar question to you. You mentioned EdTech earlier, and amazing growth of EdTech in India. Do you see other areas of growth in technologies, tools, software because of the situation we are in, and how we're going to work from home and get distributed all over the map?
Yeah, I mean, I think, no, absolutely, right. I do think this is going to create a whole new generation of both categories, new types of categories, but also a new generation of companies in existing categories, right? And apart from, clearly, as Abhishek mentioned, work from home, is going to be massive, and it's real. We already know, and it's going to change a lot of things, right? And Abhishek mentioned several of the areas that will impact. But also, if you look at digitalization more broadly, right, of companies, I'd say we've been in sort of the second inning of like digitalization of companies. But if you look at most of the world, let's say in developed worlds, right, most companies have very little digitalization so far, right? Up until March, there were CIOs that were just saying they can only move sort of very few use cases to the cloud, right? And so I think the digitalization of enterprises of all sizes, right, large, mid-size, SMB, is going to dramatically accelerate, and that's going to create opportunities for both new entrants in existing sort of cloud categories, because they'll just do it differently and hopefully they'll do it better. But also lots of existing categories, right? I mean, look at the US. I'm always amazed at, you can pick some micro vertical and like it's $100 billion market, like a $3 billion market, right? And there's so much legacy software, right? And I think all those businesses, right, whether it's a doctor's clinic or whether it's a gym or whether it's a spa or whether it's a community swimming pool. I mean, I have this I have an angel investment in a company that does this scheduling software, and all of a sudden, like every community center now has to schedule when you're going to go to the pool, right? Boom, the thing it's just like doubling every other day, because it was like it was a very small use case, right? But so I think digitalization of businesses of all sizes will accelerate, and I think that is going to just lead to lots of opportunity, right? So you look at e-commerce. You look at the data in the US, right? E-commerce penetration in US has gone from 18% to 28% in 2 months. In the world's largest economy, I mean, 28%, by the way, is where China was pre-COVID, right? So for the longest time, we said China is way ahead on e-commerce and, et cetera, absolutely true. And now China continues to be way ahead. So if you're a business today, you finally realize that e-commerce is not a nice to have, right? You've got to, it doesn't matter whether you're a bank, whether you're an insurance company, whether you're a retailer, whether you're a consumer brand. I was talking to the team that runs a lot of the, snack brands here, right? With the largest snacks company. I mean, during the lockdown period, the only way they could get snacks to customers is like, through e-commerce, right? And they were not tooled up for e-commerce at all. So whether it's e-commerce enablers, and you look at e-commerce enablers, right? I mean, they're probably like dozens of billion-dollar companies you can build just on e-commerce enablers. Because a lot of the tools that are out there, either are subscale or, some are very good, but very few can handle it. So I would say this is going to be impacting, many sectors. It's almost like every sector you can look at now and say, how is this sector going to change, right? Actually, yesterday I was talking to an Indian IoT company that does, integrated solutions for IoT, primarily building sort of software. Their business, they can't keep up because they came up with some use cases for things like in factories, right? How do you make sure that people are wearing the right PPE? How do you make sure that social distancing is happening? How do you make sure that their temperature is measured? And companies like Unilever don't want to do it every day. They want to do it every hour, right? And all of a sudden, that requirement, IoT, at least in our part of the emerging, let's say India, Southeast Asia, IoT penetration has been quite low within enterprises, right? Even within some of the largest companies. But now you're going to see, but it's not going to be led by traditionally what we thought were going to be the use cases, right? It's going to be led by some of these new use cases around health, safety, sanitation, and it's going to go through. So my view is almost like take vertical by vertical and try to understand how the priorities of those companies, right, whether it's large companies, mid-sized companies, small businesses, are changing, and then think through sort of how you would solve those sorts of problems. So I think we're going to, this is going to lead to a massive number of new companies. Some in existing categories, but many, I think, that will come up in categories that we haven't seen yet.
Got it. So we're almost at our last question. So we'll start with Rajan. So on one side, survivability is important. On the other side, we want to make sure that the growth continues at some measure. And of course, in last 90 days, we have seen cost control measures across, layoffs happening across. Do you think companies should be worried about this uncontrolled growth of software and tools in the enterprise? In the name of productivity and working from home, we are buying so many things to become more productive. So is there a thought process of reining in on expenses or doing spend management of these software tools that we will adopt in the enterprise?
No, absolutely. Look, cost reduction is the first, second, third, and fourth priority for every CEO in the world and every CFO in the world, right? And as more than anybody else in this, there's sort of three segments of companies, right? There are a segment of companies that embrace the cloud, and I would say by and large, almost all of them probably have too many endpoint SaaS applications where the CFO really doesn't have any visibility to exactly how much they're spending. Because the powerful thing about bottom up for a SaaS company is it's quick. The not so great thing as a CFO is he or she has no idea what is being spent where, right? So I think that's one segment, and I think in that segment, there is a need for tools that can help sort of, number one, provide visibility, number two, provide visibility on what they're using, how much are they spending, what's being used, what's not being used, and consolidate, right? So that's one segment. I think the second segment, which is maybe companies that are early in their journey, that are just embracing. And for that segment, I think there's what's really important is being thoughtful, because there is, you go to G2 Crowd, right? There are 80,000 SaaS applications. So unless, I can't imagine how any functional leader or CIO or CTO is now able to figure out what they should use, right? So is there a way to kind of, provide some intelligence to what you should be buying, and again, being thoughtful about how do you make sure that you keep on top of, how much software do you have, how much are you spending, what's being used, what's not being used, and then keep optimizing. And then there's a third category, which I think is still a very large segment, even within the global Fortune 2000, which is, a lot of companies are just beginning to embrace digitalization in the way that they should, right? I think it's just, we have to go through what we went through with sort of the pioneers over the last decade. So long answer to your question, definitely there's a large segment of companies that have sort of, got way, hundreds of, SaaS products that they have in their enterprise. The CEOs and the CFOs don't have visibility to what they bought, what's being paid for, and most importantly, what's being used, right? I think with SaaS, the most powerful thing is you got to know like what's being used and what's not being used, and then, take decisions on the products that are not being used.
Got it. Abhishek, same question to you. So do we see a rein in on this unbridled sort of expenses that are happening because of, hey, use a tool A to become more productive, tool B to become more efficient? Is there an end game to this?
Yeah, I think the SaaS sprawl is a real problem. Every time I miss a couple of quarters, and I know there are so many more tools that any of our portfolio companies are using, I think the way I would answer your question, Indus, is I think in good times everything appears like a need, but I think these are the times you know, companies are also realizing what's truly a need and what's truly just a want. And somewhere there is a, you know, a balance between the two that every company is trying to find by rationalizing the whole you know, SaaS usage footprint. I think the decentralized buying of software, I don't see that changing in times to come. So I think there is probably going to be more, not less, confusion around who is buying for software in the company, how is it being paid for, are we still paying for it even after the employee has left the company. So I think if I have to summarize, there is growing recognition that there is an asymmetry of intelligence between buyer and software and seller of software. If you look at seller of softwares, you know, they have all the alerting mechanisms, all the customer success software, including Gainsight and, you know, tens of other things to see when is a renewal coming up, when do I have a slight, you know, the slightest opportunity to make an upsell. But if you look at the world of any software buyer organization, the fragmentation and decentralized nature of software buying, and to what Rajan was saying, you know, in the just, you know, multiplying choices of thousands of SaaS products that you can use. I think there is definitely going to be more financial control, and you know, after all, you can only spend a certain fraction of your budget on technology. I mean, obviously there is growing need for technology, but I think the rationalization will continue to happen, and it's not only becoming, I believe, a CFO level priority. Sooner or later, this will also become a CEO level priority and a board level priority. As you know, the spend continues looking more significant. I'll take an analogy here. I think US as a whole, you know, on the macro level, you know, nobody ever looked at, for example, the healthcare spending, and that's why I think now it's becoming a country level issue where healthcare spending is 20% of GDP, which is insane. So I think even if you look at software spending inside a company, I think there will, as it continues to spiral and starts looking a bigger and bigger, you know, share of the overall pie of cost structure, I think there's got to be a lot more control. It can't remain chaotic the way it has been so far.
Great set of sound bites from you, Abhishek, and also from Rajan. Appreciate your time today. You know, thank you for coming over, and there was a fantastic conversation.
Thank you, Indus.
Thanks, Rajan.
Thank you, guys.